Here is the number that matters this Friday morning. Gold has just snapped back to around $4,360 an ounce after sliding to a fresh weekly low. That U-turn is not random. It is a direct reaction to a softer US dollar, which is losing traction as traders rapidly rethink the Federal Reserve's next move. The key battleground sits immediately overhead, a resistance zone running from $4,386 up to $4,455. That is the supply area where sellers have repeatedly rejected rallies. If gold can push into that band today, the recovery has real momentum. If it holds again, the rebound could stall before the weekend. The trigger is softer US inflation data. Producer Price Index figures, known as PPI, came in below expectations after a subdued core consumer price index reading earlier this week. Together, those reports have forced markets to dial back bets on a September Federal Reserve rate hike. Before the CPI release, traders priced roughly a 54% chance of a hike. After the CPI and the latest PPI, that probability has dropped to about 40%. This matters for gold because lower expected interest rates reduce the yield advantage of holding US dollars. The dollar index has slipped again, making gold cheaper for international buyers and removing a major headwind for a metal that pays no interest. Right now, the bounce matters because gold is testing the lower edge of a well-defined supply zone. The $4,386 to $4,455 area has acted like a ceiling on previous rallies, and it is the first real test for buyers. A softer dollar and fading hike bets give traders the confidence to challenge that ceiling. But this is not a one-way trade. Early Asian strength can evaporate quickly if US data surprises to the upside. Today's US retail sales report is the next catalyst. A weak retail sales figure could push the dollar lower again and support gold. A strong print could revive September hike bets, strengthen the dollar, and cap gold below $4,386. Looking ahead, the path of least resistance depends on two variables. First, can gold hold above its intraday low and break into the $4,386 to $4,455 resistance zone? A decisive daily close above the upper boundary would signal that buyers have absorbed the supply and could open the door to a new leg higher. A rejection inside that zone would suggest the broader downtrend remains in control. Second, today's US retail sales data matters more than usual because markets are already positioned for softer demand and a weaker dollar. If the data misses expectations, September hike odds could fall further. The base case is consolidation between the weekly low and the resistance ceiling, but the risk of a breakout is clearly growing. So the real story today is not simply gold moving higher on a chart. It is that the US dollar is losing its interest rate advantage, and that shift is forcing a broader reassessment across precious metals. Gold's bounce from the weekly low is a symptom of fading September hike bets, not yet proof of a new bull market. Watch the $4,386 to $4,455 resistance zone and today's US retail sales number before drawing conclusions. If the dollar stays soft, buyers may finally achieve the breakout they have waited for. If the data strengthens the dollar, this rebound could become another selling opportunity. Gold is trading less as a commodity and more as a mirror of Fed expectations.